Yeah, welcome back, everybody. Time for part two of our session today. The lunch break is over, and I'm really excited to introduce our next keynote speaker. It's Alasdair Macleod, and I've said it before, I've hosted a fireside chat just with him, but I really love the interviews with him because he's not just US focused, but he's able to zoom out and look at the bigger picture, which I really, really appreciate, and put a lot of context around what is happening in the gold space. We just filmed a fireside chat where we talked about de-dollarization, trends affecting gold, credit swaps, credit lines, debt, so much more. Alasdair, you're going to go into so much detail, I think, but it's going to be hugely insightful. That's why I'm extremely pleased to have him here at the conference. He's the head of research at Goldmoney, so he deals with gold and money on a daily basis. And to Alasdair, I'm really pleased that you're here. Thanks for making the time. Thanks for making the trip, and please go ahead.
Thank you very much. Yeah, huge topic. It's always difficult to know quite where to start. What I'm going to do, I think, is start with a little bit of geopolitics, because that does set the scene for everything that is going on. The world is dividing into two. Now, if you read Western media, you wouldn't necessarily know that. We dominate the world economically, financially. Well, we used to dominate it economically, but China, on a purchasing power basis, its economy is now significantly larger than America's. So it's no longer true. We have this sort of, we're 1.3 billion people, and we are deindustrializing. I mean, amazingly, we're trying to do away with fossil fuels. We have changed our politics hugely, and we ignore economic factors in our politics almost completely. Contrast that with the two Asian hegemons, Russia and China, who are working in partnership, one as a main supplier of commodities and raw materials, and the other as an organizer for the whole Asian economy. Now, against our 1.2, 1.3 billion people, that's 3.8 billion people in that area alone. Now, what China has been wanting to do for a long time is to do away with the dollar, for obvious reasons. It sees the Asian backyard as its, well, not quite its own territory, but certainly under its own influence, and would rather have its own currency there. It has not upset the apple cart deliberately, because China has still depended in large measure on exports to America and Europe. It's become the manufacturing center. We did away with all our production. I mean, Germany is a notable example. It's not an example, it's a notable exception to this. And consequently, all our production is there. China runs its economy on savings. We've done away with our savings, with the exception of Germany, who's cannibalized her savings into the euro system. Savings are terribly important, because if you inflate the amount of credit in an economy and you don't have savings, then that feeds pretty directly into consumer prices. If you have savings and it doesn't feed directly, what happens is that people, instead of spending it, they save it. Now, China's savings ratio is over 40%. Now, what that means is that the average person, out of their after-tax income, saves 40% of it. That's an extraordinary ratio. And that's why the rate of inflation in China is under 2%. It's also why Japan over the years has been successful with a strong currency. Strong currency, why? Because consumers have not been undermining the purchasing power of the currency by spending what they would otherwise save. And before the creation of the euro, the same was true of the Deutsche Mark, of course. So savings are terribly important. Now, that's one of the differences that I would say we should note between what's going on in Asia and what's going on in the Western alliance. Now, all this was thrown into sharp relief when the Americans decided to sanction Russia And of course, as America's allies, we all followed in. As NATO, which according to Lord Ismay, who was the first Director General of NATO, said, the purpose of NATO is to keep Americans in, Russians out, and to subdue Germany. Wow, great. And they're still doing it. That was founded in 1948, the year I was born, and they're still doing it. And I'm surprised in a sense that the Europeans haven't come up with a separate policy, foreign policy from NATO. Because that is the key thing. This about the Ukrainian situation. Really, what America wants to do is to stop Germany becoming a commercial trader, if you like, partner with Asia, where the true opportunities for Germany really lies. Anyway, I'm not going to go into that political side because it's too controversial. But as far as we are concerned, we have a new situation. We have a banking crisis. Now, this banking crisis does something which I think the collective efforts of Russia and China could not achieve, and that is make the rest of the world frightened of being highly dependent, overly dependent, totally dependent on Western financial systems. Vladimir Putin, back, I think it was in June last year, there was something called the St. Petersburg Economic Forum, and that was in June last year. He stood up and said, why would you hold dollars and euros in your reserves when the Western alliance, or the unfriendlies as he calls us, can cut you off like that? This is what actually happened to Russia. He also said, why would you store your gold in their financial centers, London, New York, Paris, Zurich, whatever? Get it under your control. Now, the relevance of this is that there were 81 official delegations who attended that conference, and there were goodness knows how many other unofficial government attendees out of the 14,000 who were reputed to attend. So they have been warned. They were warned last July that as risks escalate in the Western financial system, get the hell out of it. And we're now seeing that. We're now seeing country after country after country saying two things. Saying, we want to join you. You know, if we're not in Asia, we join BRICS. We want to get out of the dependence on dollars, euros, whatever. It's too risky. And this is a point which I think few people understand. When you actually hold dollars or euros, you don't just sort of have it in notes in the basement of your central bank. No, it's invested in US treasuries or French bonds or whatever. And it's credit. Now, one of the themes of my speech today is going to be about credit. Credit is something which people do not understand. They think credit is money. It is not. Legally, and we go back to Roman times, and I'm going to walk you through the history of it. Legally, the only money is gold. The rest of it is credit. Now, this is the point that J.P. Morgan, the original John Pierpont Morgan, made before Congress in 1912. And it's still true today, despite all the propaganda that we've been told otherwise. This really matters, and it matters at a time of escalating risk when you are entirely invested in credit. Because everything we deal in is credit. If you own shares, you are buying into an income stream in perpetuity. You own bonds, obviously. You know that's debt, and the other side of it's credit. Of course it is. Credit is so much part of our lives. When you have someone come to do some work on your house, he does the work first. Okay, you owe him a debt, which you will discharge at the end when you're satisfied with his work. He is giving you credit. Even at that level, credit exists. It is entirely our financial system. Gold has been excluded from it. The only exception is central banks, who understand, at least partially, what I'm telling you and what I will tell you. because they have been accumulating gold, as John Reed, the excellent John Reed, said this morning. Amazingly, central banks have been building their gold reserves. And guess who? It's almost all emerging markets. They've woken up to it. They listened to Putin back in June. They know, they begin to suspect that they should actually get the hell out of our financial system. This is a very, very important development. Now, to work. If I can get this going. Hold on, I'm going to turn this round so I can see what I'm talking about. Right. First thing, I did mention this briefly, we've got to define money, currency, and credit. I find increasingly that economists seem to think that the folding notes that you get in your pocket is actually money. No, it's not. In our currency, pounds, we still have the vestiges of the relationship. If you read every banknote issued by the Bank of England, signed by the cashier, chief cashier, it says, I promise to pay the bearer on demand the sum of, and then the face value of the note, £10. Now that goes back to 10 sovereigns, which we suspended before the First World War. Now 10 sovereigns, to give you a rough idea, a sovereign has moved in terms of its value measured in pounds from £1, one sovereign, to £1 now buys 1/400th of a sovereign. Now I put it that way because this is actually what's happening, and I think this is a very important point. When you talk about inflation, when you talk about rising prices, it's not rising prices. It is the falling value attached to credit. Whether you print it or not, it doesn't matter. What I'm looking at is the value of credit. It has fallen substantially. And if you think back to America at the turn of the last century, or certainly before 1933, the dollar was fixed at, gold was fixed, if you like, at 20.67 to the ounce. It then got devalued. Today, it's 100 times that. There's 1% left, 1% left. That's what's happened. This is what happens to credit over a long time. Yet we think it's money. It is not money. It is quite simply credit. Now the Romans invented banking, along with a few things that went with it. It's something that evolved under Roman law. And there is a history to that. I'll run through it very, very quickly. Now, the legal definition of money is gold and silver coin or billion. Right, let's go on. Right. It all started with the 12 tables in 448 BCE. And this was when the first Roman coin came out. And this was the ice. And it actually weighed just under a third of a kilo. And it was made of bronze. They evolved a bit from there. Gaius was an interesting juror. He wrote very extensively in the early 2nd century AD, Common Era they call it now. And he set the tone for common law in England at that time. And of course, the Romans had left England before Justinian, who sort of collected everything together and provided the basic definition for money and credit going from there. But the real two jurors who came up with the differentiation were Ulpian and Paulus. Now, basically between them, they defined money as being in two forms, or rather, medium of exchange being in two forms. One was depositum, which you would take a bag of money or whatever it was, and you go along to the bank and you say, look after this for me. That's deposited with the bank. That is custodial function. Not to be confused with our bank's deposits today. That is mutuum, where you go along to the bank and you give them some money, or you transfer credit from somewhere else, and you say, put that into my account. And what happens then is that the bank owes it to you. You are a creditor of the bank. And this was set out by these two jurors. It was also confirmed later by Alexander Severus, some 50 years later. And then finally the whole lot was put together in Justinian's Pandex, and that was 530 AD. The problem was that Justinian was an emperor in the Eastern Empire. They were still talking Latin, they were still using Latin, and this was all written in Latin, and they were applying the law to predominantly a Greek population. And so eventually this was sorted out and consolidated into what's known as the Basilica, which was under Basil I and his son, and that was some 400 years later. So that was, if you like, where it went. Now, from that, of course, we had in Western Europe, or the Western Empire and its successors, took on the Pandex. In other words, the differentiation between gold as money and the rest is credit. The Basilica was taken on by the inheritors of the Eastern Empire, which actually said exactly the same thing. And guess what? We Europeans then colonized the rest of the world. So this law, which was Roman in origin, was spread throughout the world. And the reason why it has survived is because it is right. It survives because every time there is a crisis, what happens? We come back to these basic facts. So this isn't just me saying, I'm a gold bug and so on and so forth. This is the law. And do not take the propaganda from governments. They can confiscate your money. Of course they can. As we saw in 1933. And we had it in England too at one stage. But it doesn't stop it being money. Now, the importance of credit, I think you now appreciate that money is not part of our system at all. It's entirely credit. It is the basis of our wealth. It allows us to quantify our wealth. And wealth comes in three forms. We've got corporeal wealth, which is material wealth. Buildings, land, commodities, cattle, livestock, grain, all the physical stuff, including gold. And then you've got immeasurable wealth. And immeasurable wealth is your personal skill. You might be a plasterer, so you can earn money plastering. There is a value in that, because it is a value which gives you earnings. So that is immeasurable wealth. And it incorporates patents, trademarks, and so on and so forth. Incorporeal wealth is abstract rights, and this is where credit comes in. That's all credit. So what we're looking at is bridging the corporeal, which is gold, physical wealth, and the incorporeal wealth, which is credit. Now, the modern monetary system is, as I said, purely credit. But that is subdivided into banknotes, which we know, and bank credit in the form of deposits. And the ratio in dollars is around about 8.2 times, but about half of that, it is estimated, is actually outside America. So the real ratio is probably about twice that, say somewhere between 16 and 20 times. Now, credit needs an anchor. This is desperately important. People think that the quantity theory of money is what drives the relationship between what they call money, which actually is credit, and its purchasing power. Well, there is an effect, but it's not that great. It's credit that needs an anchor. Now, if you give credit an anchor, and the chart I've got here is just illustrates how at a time when bank credit expanded very, very rapidly, prices held pretty steady. I mean, as I say here, between 1844 and 1900, the wholesale price index was unchanged. Now, I would admit that you can't measure a general price level. I mean, this is one of the beefs I have with modern macroeconomics. It's a load of rubbish. You can't measure it because for each of us it's different. But as a rough indication, you can see what's happened. And as the banking system, which is the credit system, was perfected over the course of the 19th century, you saw that the fluctuations in the value, if you like, of that index just diminished and diminished and diminished. So you need that golden anchor. Now, there was a big expansion in broad money supply over that time. It was about 11 times, according to figures from the Bank of England. And yet, what was the price effect? Nothing. We saw something similar after the Bretton Woods. I mean, Bretton Woods fixed the dollar at 35 of them to an ounce of gold, and prices were pretty stable, and I'll show you in another chart in a moment, until the whole system fell apart. Now, the strains were created, if you like, by excessive growth of credit. And also, in the case of America, they were bundling notes into Vietnam, first of all Korea and Vietnam, weakening it at the central bank credit level, which eventually flooded home. And of course, the Bank of France, because that was originally Vietnam was Indochina, the Bank of France led the way in terms of trying to redeem these unwanted dollars for gold at the U.S. Treasury. So. I think dispel any idea that there is some sort of iron relationship between the expansion of credit and its purchasing power. The point is it has to be anchored in value. This is brought out in this next chart, which is of oil. If you go back to 1950, the price of oil was $2.57 a barrel. And it was more or less that until the Bretton Woods system fell apart. And then you can see what happened. The price of oil in dollars started shooting up. But interestingly, the yellow line there shows the price of oil in gold. That price remained more or less constant. And any historian of money will tell you that Diocletian's edict, which was back in, 3rd century AD, fixed prices at a maximum level. And if you look at some of the constituents, if you like, of that, written in stone, the maximum prices, forget all the slave markets and all the different categories of trading in that, because they don't exist now. But if you look at things like beer, you look at clothes and so on, staples, prices haven't moved that much over all that time. So what does that tell us? It tells us that not only is gold money, but it's stable over the sweep of history. So I return to this oil price. What's the real money? What's the real money in this? Do you take it as dollars, as the US government would have us, or do you take it as gold? I mean, not only is the price of oil immensely volatile when priced in dollars, but at one stage, it was up to $140 a barrel. That was before the last financial crisis. It's come down a little bit recently after the spike last year following sanctions against Russia. But, the trend is quite simple. What we're looking at is the devaluation of the dollar. We're looking at the purchasing power of the dollar collapsing and the currencies that are tied to it, which is what this next chart shows. I mean, since 1971, when we came off the Bretton Woods system, sterling has lost 99% of its purchasing power. The dollar has lost, on today's price, something like 98.75% of its purchasing power. Something like that. The euro, when this chart takes into account the composition of the euro before the year 2000, again has been not very clever. I mean, it's all gone. It's all gone. And we don't realize it. As we live our day-to-day lives, we take this, if you like, as the value for which we exchange goods and services. When we do a transaction, we know that what we've got in our hands to sell can be exchanged for euros or pounds or whatever it might be. And the buyer, equally knows that all the price variation is in the goods. But actually, the whole thing is a myth, because underlying it, you've got this collapse. And now we've got a banking crisis, and that's going to accelerate it. Now, the point about the banking crisis, and I've got to hurry up a bit, is that banks have become very highly leveraged. Now, this is the ratio of balance sheet assets to Tier 1 capital for all US banks. And you can see that since 1990, this ratio has been going up and up and up and up. This chart is a measure of the risk that shareholders in banks face from contracting credit, because the losses are magnified by this ratio. And this is why the system is in real trouble. And this is why there is a cycle of bank credit which drives the Austrian business cycle. They should really have defined it more as a cycle of bank credit. So we've gone through various phases. We had the Bretton Woods Agreement, and then we had the petrodollar and so on from the 1973s onwards, and that's now being eroded very, very seriously. And what we now have is we've got, if you like, a move away from our system to Asia, to currencies which are more based on real things. They make real things, not ephemeral services. They have real commodities. So the characteristics of these currencies in Asia are likely to adopt that. But because everything in the West is falling apart really at an accelerating rate, this is more than likely to involve gold backing some of these currencies. And there's a guy called Sergei Glaziev, who is Putin's chief economic advisor, who's been planning to back a new currency, a new trade settlement currency with gold. He started off by a broader remit, but he's narrowed in on gold. He's also now talking about backing the ruble with gold. And of course, there are great advantages to this. I mean, at the moment, if you want to borrow in rubles, you've got to pay something like 13–14%. If it was gold-backed, then as confidence in ruble credit begins to build that this link would be maintained, then that rate would fall to somewhere between 2% and 4%. What's not to like about it? That's the way it's going to go. So that's, I think, the most important. Now, I've just got one chart here which will put this in a different context. This is the yield of the 10-year US Treasury, really from after the Big Bang, when banks started really getting involved in purely financial activities, stockbroking, investment management, and so on. And you can see this long-term decline in the yield on the US Treasury bond market has now come to an end. This is a major, major event. The idea that you're actually going to see interest rates begin to ease, forget it. I'll tell you why. Two reasons. Firstly, interest rates are compensation to foreign owners of your currency for loss of purchasing power. I can go into a bit more detail on that, but I don't have time. Secondly, who prices credit? It's the banks, not the Fed, not the ECB. They can sort of set a market price, but the reality on the ground is that you go along and talk to your bank manager, and at anything like these low rates, he says no. And higher rates, he will probably still say no because it will upset your business plan. It is banks that set interest rates when you have contracting credit. That's desperately important. So dismiss any idea that there's going to be anything other than a temporary move down in interest rates. They will have to continue to rise in order to contain the collapse of currencies. And if they're not permitted to rise by the Fed and other central banks, because their preferences are to rescue their governments whose finances are deteriorating, they themselves are deeply in debt. Every major central bank has negative equity. I mean, the Bank of Japan, which started doing QE back in the year 2000, I calculated that last year they lost something like 4,500 times their equity capital. Now, we say it doesn't matter because a central bank can always print more money. Well, that's the point I'm making, actually, partly. But then how are you going to recapitalize the ECB? The ECB has as shareholders all the other central banks, the Eurosystem central banks. So if you're going to recapitalize the ECB, you're going to have have enabling legislation in almost every jurisdiction which requires it, including Germany, because it's not going to happen. It's not going to happen without your politicians getting involved in Germany, I can assure you. I think you might confirm that. What will happen, basically, is questions will be asked, well, we need all this money. Why don't we get paid what we're owed on target 2? But then they don't understand what target 2 is. You can see we're getting into a situation from which our central banking driven system has really got no escape. And that is good for gold. It's good for silver on the back of gold. So the only investment strategy which makes any sense at all, if you're going to stay in fiat credit, is to go for the extractive industries, because there's a very bad story in our Western alliance, but there's a bloody good one out in Asia, and that's going to keep demand for these things going. Thank you very much. Any questions? I think I got 15 seconds for a question. There's one in the back there.
Well, at the moment, the West holds the majority of the gold reserves. So how do you think the East can change this?
Well, the East has got a lot of undeclared reserves. There is a fund in Russia, which is a state fund, which my sources tell me have probably got about 10,000 tons in it. And recent legislation has been passed to mobilize that, if necessary. I reckon that China has probably accumulated out of sight, following some legislation which appointed the People's Bank of China to do this, somewhere between 20 and 25,000 tons. And that was before 2002, when they then permitted Chinese citizens to acquire gold. And as John Reed said, the World Gold Council helped advise the Chinese on the setting up and the development of that exchange. They now have over 21,000 tons of gold in their hands. So this is, they've got loads of gold, and a lot of it's undeclared. I mean, the nature of gold is you don't know who the hell owns it, unless they tell you. One question here.
What do you think, what is the time when this system will collapse?
I think we're in the early stages of it. I mean, we're beginning to see banks fall apart. I suspect there may be a little bit of stabilization, if you like, but the reality is that any stabilization is going to be followed by tightening credit. Because if you're a banker, you may well be a banker. I mean, in these very febrile conditions with escalating risk the whole way across, are you going to expand your balance sheet? No. You're going to take every opportunity to reduce it, and that's what's going on. Yeah. So, it's it could be anything between, I think, sort of 6 and 9 months and overnight. Well, thank you very much indeed. And Kai should be somewhere, I think, to take over. You're taking over. Great. Thank you very much.
Thank you.
Thank you.